When a 16-year-old walks into a bullion shop and walks out with tubes of silver eagles and maple leafs, most people see a feel-good story about generational wealth transfer. When a veteran dealer with decades of market experience tells that teenager, his grandfather, that silver could hit $200 an ounce, and then corrects himself to say 200 is the plan. That's not a prediction, that's intelligence. There's a fundamental difference between speculation and positioning. Retail investors speculate. They watch charts, follow trends, react to headlines. Professional dealers, the people who actually handle physical metal every single day, they don't speculate. They position based on what they're seeing in supply chains, wholesale networks, and institutional order flow. And right now, dealers are speaking in very specific numbers. The conversation happened in a shop in early 2025. A grandfather bringing his granddaughter to buy her first silver. The kind of transaction that happens thousands of times across the country. But embedded in that casual discussion was a data point that reveals everything about where the silver market is actually headed. I think it can go as high as 200, the dealer said. Then he paused. 200 is the plan. That is the plan. Not a guess, not a hope. The plan. This matters because bullion dealers exist at a unique intersection in the precious metals market. They see retail demand in real time, panic buying, steady accumulation, or complete indifference. They manage relationships with wholesalers and mints, so they know when supply is tightening before any official announcement. They handle institutional orders that never show up in public data. Sovereign wealth funds, family offices, private banks, moving metal in quantities that would move markets if disclosed. When dealers start using phrases like the plan, they're not sharing technical analysis. They're revealing that the people who control supply, the refiners, the miners, the central banks, the exchange operators, are working toward a specific outcome. And that outcome is a silver price that most investors currently consider impossible. Compare this moment to the silver spike of 2020 and 2021. That move was demand-driven. Retail investors piled into the market. Reddit communities coordinated buying pressure. Premiums spiked because mints couldn't keep up with fabrication demand, but the underlying supply chain remained functional. Wholesalers could still source metal. Exchanges could still deliver. The system bent, but it didn't break. What's happening now is structurally different. This isn't about retail demand overwhelming mint capacity. This is about wholesale supply breaking down at the institutional level. Dealers aren't raising premiums because they're busy. They're raising premiums because they can't reliably source metal at quoted prices. One dealer mentioned in passing that if Samsung or Tesla needed industrial silver, they should call him directly. The joke contained a truth. Major industrial consumers are already bypassing traditional procurement channels because those channels are failing to deliver contracted quantities on time. When Apple or Samsung can't get silver through normal supplier relationships, when they have to send procurement teams into the secondary market to compete with coin dealers, the spot price on a screen becomes meaningless. The dealer's $200 target isn't based on chart patterns or Fibonacci retracements. It's reverse engineered from a simple question. At what price does physical supply meet physical demand? And the answer, according to people who handle metal every day, is somewhere between $180 and $200 per ounce. But here's what makes that number almost irrelevant. The same dealer who confirmed the $200 plan also said something else. He said the LBMA, the London Bullion Market Association, which operates the world's largest over-the-counter precious metals market, will change the rules rather than default. I think they will change the rules, he said. When asked what happens if the LBMA can't deliver physical metal, his answer was immediate. They'll change the rules worldwide. That statement is more important than any price prediction, because it reveals the actual mechanism. The plan isn't to let silver find its natural price in a functional market. The plan is to manage the failure of the paper markets through legal modifications that allow exchanges to settle contracts in cash rather than metal, which means there will be two prices for silver. The price paid to people holding paper claims, settled in cash at whatever number appears on a screen, and the price paid by people who actually need physical metal, which will be whatever the holder demands. The dealer's confirmation of $200 wasn't optimism. It was a warning embedded in casual conversation. He was telling anyone paying attention that the people who run the market, the LBMA, the COMEX, the central banks, the bullion banks, are preparing for a controlled demolition of the paper-silver market. And when dealers start speaking in specific numbers like that, when they use phrases like, that is the plan, they're not guessing, they're repeating what they've been told. There's a moment in every financial crisis when the authorities stop pretending the system works. They don't announce it, they don't hold press conferences, they simply change the rules. In March 2022, the London Metal Exchange halted trading in nickel. Prices had spiked to over $100,000 per ton. Certain participants faced catastrophic losses. So the exchange did something remarkable. It canceled trades. Billions of dollars in executed transactions simply erased. Market participants who had made correct bets discovered their profits didn't exist. The exchange had rewritten history. This wasn't a glitch, it was a choice. The same choice is being made right now in the silver market. Except this time, the changes are happening before the crisis becomes visible to the public. Both the LBMA and COMEX, the two dominant silver trading venues on the planet, are quietly modifying their operational frameworks. New margin requirements, extended delivery windows, expanded cash settlement provisions, language about force majeure and unforeseen supply disruptions. To most market participants, these look like routine administrative updates, technical adjustments, regulatory housekeeping. They're not. These are preparation moves, the kind of changes institutions make when they know what's coming, and they need legal cover for what they're about to do. Start with the most important modification: cash settlement clauses. Every futures contract contains language about how disputes get resolved. Historically, commodity futures existed to guarantee physical delivery. A farmer could lock in a price for wheat. A manufacturer could secure copper supply 6 months in advance. The contract was a promise, backed by the exchange, that physical material would change hands at a specified price. But silver contracts now contain expanded provisions for cash settlement. If the exchange determines that physical delivery is impractical or faces unforeseen constraints, they can simply pay the contract holder in cash at the current market price, end of obligation. This seems reasonable until you understand what it actually means. Imagine signing a contract to buy a house at $300,000. You put down a deposit. The closing date arrives, but the seller informs you they're not selling the house anymore. They're just going to give you $300,000 instead. Except in the time since you signed the contract, identical houses now sell for $600,000. You get your money back, but you don't get the asset you contracted to purchase. That's exactly what cash settlement does in a rising market. The LBMA has gone even further. They've modified their unallocated metal accounting practices. Under the old system, clients who held unallocated silver had a legal claim to physical metal. It wasn't in their possession, but it existed somewhere in the vault network. The relationship was Bailey-Baylor. Client owned metal, bank stored it. The new language is more ambiguous. Unallocated holdings are now described as credit exposure to the Bullion bank. Not ownership, exposure, the same language used for derivatives. This isn't semantic, it's legal repositioning. If a client holds allocated metal, they own specific bars with specific serial numbers in a specific vault. If the bank fails, that metal belongs to the client. It's not part of the bank's assets. But if a client holds unallocated metal described as credit exposure, they're an unsecured creditor. If the bank faces liquidity problems, the client stands in line with everyone else. They don't own metal. They own a promise to receive metal, or the cash equivalent, at the bank's discretion. Why would the LBMA make this change? Because their system was built on a dangerous assumption that most clients would never demand physical delivery. The banks could operate with fractional reserves, holding 1 physical ounce for every 10 or 20 or 50 ounces of paper claims, because redemption requests were historically rare and predictable. But that assumption is breaking. The COMEX is seeing similar stress. Since 2020, the exchange has increased margin requirements on silver contracts 7 times. Each increase makes it more expensive to hold a position. The stated reason is risk management. The actual effect is pricing out speculative participants who might demand delivery. And delivery is the pressure point. In early 2025, COMEX registered silver inventories, the metal actually available for delivery against contracts, dropped below 80 million ounces. At the same time, open interest, the number of contracts requiring potential delivery, exceeded 800 million ounces. The ratio was 10 to 1. For every ounce of physical metal in the warehouse, there were 10 paper claims against it. But even that number is misleading, because much of the registered inventory is already encumbered. It's pledged as collateral, it's part of exchange for physical arrangements, it's spoken for. The COMEX knows this, so they've extended delivery windows. Contracts that used to settle within 3 days now have 7-day settlement provisions. Some include 15-day windows for large deliveries. The exchange is building in time, because time is what you need when you don't have metal. Then there's the language around force majeure. Both LBMA and COMEX have expanded their force majeure provisions to include supply chain disruptions, refining constraints, and transportation delays. This used to cover acts of God, wars, natural disasters, government seizures. Now it covers logistical friction, which means if a refinery can't produce enough silver to meet delivery obligations, that's force majeure. If trucking delays prevent metal from reaching the vault, that's force majeure. If export restrictions prevent metal from crossing borders, that's force majeure. Every one of those conditions exists right now. China implemented strict silver export controls in January 2025. Kazakhstan limited refining output. South American mining operations face labor disputes and environmental restrictions. These aren't theoretical problems, they're current realities. And the exchanges have preemptively written those realities into their contracts as justification for non-delivery. This is what preparation looks like. The authorities aren't waiting for a crisis to hit before changing the rules. They're changing the rules now, while most participants aren't paying attention, so that when the crisis arrives, they can point to contract language and say everything was disclosed. History shows what happens next. In 1933, the U.S. government ordered citizens to turn in gold. The official price was $20 per ounce. Citizens complied. Then the government revalued gold to $35 per ounce. The wealth transfer happened in the revaluation after physical metal had been surrendered. In 1971, Nixon closed the gold window. Foreign governments holding dollars could no longer redeem them for gold at the promised rate. The rule changed. Dollar holders were simply paid in more dollars. The pattern repeats because it works. Change the settlement terms. Pay paper claims in paper currency. Keep the physical metal. And when Shanghai starts showing delivery failures of its own, it becomes clear this isn't a London problem or a New York problem. It's a global supply problem, being managed through synchronized rule changes across every major exchange. In poker, there's a concept called the tell, a small gesture, a facial twitch, a hesitation before betting, something that reveals the truth hidden behind the bluff. The Shanghai Gold Exchange just showed its tell, and what it revealed breaks the entire narrative that Western investors have been sold about physical-backed precious metals markets in Asia. For years, the story went like this. London and New York run paper markets, fractional reserve systems, leverage stacked on leverage. But Shanghai is different. Shanghai requires physical settlement. Real metal changes hands. It's the honest market. That narrative just collapsed. Recent reports from sources inside Hong Kong, individuals with direct access to Shanghai exchange participants, revealed something remarkable. When clients requested physical delivery of their silver holdings, they received approximately 1.5% of what they asked for. Not 15%, not 50%, 1.5%, and the rest deferred for 60 days. Let that sink in. The exchange that was supposed to represent physical accountability, the market that China built specifically to bypass Western paper manipulation, can only fulfill 1.5 ounces for every 100 ounces demanded. This isn't a logistics delay. This is systematic inventory failure. And it's happening in the one market that wasn't supposed to have this problem. Shanghai operates differently than London or New York. The contracts explicitly require physical delivery. There's no cash settlement option. No force majeure clause that allows the exchange to simply pay participants in yuan and walk away. When someone buys silver on the Shanghai exchange, they're buying metal, not exposure. Or at least, that was the theory. The 1.5% delivery rate suggests something far more disturbing. It suggests that even in a market designed for physical settlement, even in a system built specifically to avoid the fractional reserve problems of Western exchanges, the paper-to-metal ratio has spiraled completely out of control. Do the math. If the exchange can only deliver 1.5% of requested metal, that implies a leverage ratio of roughly 66 to 1. 66 paper claims for every physical ounce. That's worse than the COMEX, worse than the LBMA, worse than any ratio critics of Western markets have ever alleged. And it's happening in China, where the government controls refining, controls mining, controls exports, and controls the exchange itself. The 60-day deferral is particularly telling. It's the exact same tactic the LBMA has now codified into its rule changes. When you can't deliver metal today, you buy time. You promise delivery in 2 months. You hope that in those 2 months, either demand softens or supply materializes, or prices fall enough that clients accept cash instead. But what happens when those 60 days expire and the metal still isn't there? You defer again, or you change the rules, or you declare force majeure. The pattern is identical across all 3 major exchanges: London, New York, Shanghai, different continents, different regulatory systems, different political structures, but the same delivery stress, the same inventory shortfalls, the same desperate time buying tactics. This isn't coincidence. This is coordinated scarcity. Now layer in what's happening to physical arbitrage. In early 2025, a stunning price disconnect emerged. In Dubai, one of the world's major physical trading hubs, silver was changing hands at between $100 and $127 per ounce. At the exact same time, COMEX spot silver was quoted at $73 to $90, a $40 spread on the same metal at the same moment in time. Under normal market conditions, that spread would disappear instantly. Arbitrageurs would buy silver on the COMEX at $90, ship it to Dubai, and sell it at $127. The profit would be enormous, and the act of executing that trade, buying in New York, selling in Dubai, would equalize the prices. But the spread persisted for weeks, for months. Why? Because the arbitrage mechanism is broken. You can't actually get the metal out of the COMEX warehouse and onto a plane to Dubai. Either the metal isn't really there, or it's encumbered. or export restrictions prevent movement, or refining bottlenecks create months-long delays. So the prices diverge, and they stay diverged, because the physical metal cannot move to close the gap. This is what market fragmentation looks like in real time. Traders looking at COMEX screens see $90 silver and think they know what silver costs. But anyone trying to actually purchase significant physical quantities? Industrial users, sovereign buyers, private wealth managers. They're paying to buy prices, $100 to $127. Two markets, two prices, same metal, and the gap is widening. China's export restrictions are accelerating this fragmentation. Since January 2025, getting silver out of China requires explicit approval from the Chinese Communist Party. Only a handful of approved companies can even apply. Most applications are denied. This isn't about revenue protection or environmental standards. This is strategic resource hoarding. China understands something that Western financial markets haven't fully priced in yet. Silver isn't just a precious metal, it's a critical industrial commodity, essential for solar panels, electric vehicles, defense systems, semiconductor manufacturing, 5G infrastructure. Every technology that defines the next 20 years requires silver, and China just locked down domestic supply while the rest of the world scrambles to secure imports. The result is predictable. Asian buyers are bidding up physical metal because they can't access Chinese supply. European buyers are paying premiums because they can't arbitrage Asian prices. American buyers are discovering that COMEX delivery takes months instead of days. And at the center of this global supply crisis, Shanghai can only deliver 1.5% of requested metal. Think about what that means for price discovery. For decades, the spot price of silver has been determined by trading activity on the COMEX and LBMA. These exchanges set the global benchmark. When jewelers price their products, when miners hedge their output, when ETFs calculate net asset value, they all reference London spot or COMEX futures. But what happens when those benchmark prices reflect markets that can't actually deliver metal? The benchmark becomes fictional. It's not measuring the cost of silver, it's measuring the cost of paper exposure to silver, and those are two completely different assets. Shanghai was supposed to fix this. It was supposed to be the physical-backed alternative, the market where real supply and real demand set real prices. Instead, it's revealing that the supply problem is even worse than Western market critics imagined. 1.5% delivery, 66 to 1 leverage, 60-day deferrals, 3 exchanges, 3 continents, 3 separate regulatory systems. Identical stress fractures. This isn't a London problem that might spread to New York. It's not a Western paper market issue that China solved with physical settlement. It's a global inventory crisis, playing out simultaneously across every major silver trading venue on the planet. And when the world's largest silver consumer, China, can't deliver metal to its own citizens through its own exchange, the question isn't whether the system breaks. The question is who positioned for the break and what they knew that everyone else didn't. There's an old saying in intelligence work: once is an accident, twice is coincidence, 3 times is enemy action. London changes delivery rules. New York extends settlement windows. Shanghai defers 98.5% of physical requests. That's not coincidence. That's orchestration. And when a bullion dealer casually mentions that 200 is the plan, he's not making a forecast. He's repeating what flows through the institutional channel, the whisper network, the conversations that happen between refiners and sovereign buyers, between central bank officials and bullion bank executives, between mining company boards and their financial advisors. The plan exists. It's being executed. And most market participants won't understand what happened until the trap has already closed. Go back to 2022. An unusual pattern emerged in central bank gold purchasing data. Nations that hadn't bought gold in decades suddenly became aggressive accumulators. Turkey, Singapore, India, Poland, the Czech Republic, even China. Though their official numbers almost certainly understate reality, these weren't small purchases. We're talking about hundreds of tons, systematic, relentless, month after month, regardless of price. But here's what made it interesting. While these central banks were buying physical gold, often at elevated prices, the paper gold market remained relatively subdued. Futures positioning showed net short positions among commercial traders. The gold price rose, but not explosively, not in a way that suggested panic buying, because the buying wasn't panicked, it was planned. Someone knew that the paper markets were approaching structural failure. Someone understood that when the LBMA and COMEX could no longer deliver physical metal against their outstanding contracts, there would be a violent repricing, a bifurcation between paper claims and physical assets, and they positioned accordingly. Now apply that same pattern to silver. In 2024, the Trump administration quietly added silver and copper to the official list of critical minerals. Not just important commodities, critical minerals. The designation matters because it unlocks strategic stockpiling authority, triggers national security procurement protocols, and justifies export restrictions if needed. The decision wasn't front-page news. Most investors missed it entirely. All right, but sovereign wealth funds didn't miss it. Defense contractors didn't miss it. Battery manufacturers didn't miss it. When a government designates a commodity as strategically critical, they're signaling something very specific. We believe supply constraints are coming, and we're prioritizing domestic access over free market allocation. That's the language of scarcity preparation. At the same time, mining sector consolidation accelerated. Major producers began acquiring junior miners with silver-heavy reserves, not gold-silver deposits, primarily silver. The acquisitions happened at valuations that seemed expensive based on current silver prices, but made perfect sense if the acquirer expected dramatically higher prices within 24 months. These weren't speculative plays. These were strategic resource capture operations. Coeur Mining, First Majestic, Hecla, Pan American Silver. The list of companies either acquiring assets or being acquired themselves grew throughout 2024 and into 2025. The message was clear. Secure production capacity now, before the supply crisis becomes public knowledge. Now connect the dots. Central banks accumulating physical gold while paper markets stay calm. Governments designating silver as a critical mineral. Mining companies consolidating production assets. Sovereign wealth funds moving capital into physical commodity storage. And simultaneously, the LBMA modifies unallocated account language. COMEX extends delivery windows. Shanghai implements 60-day deferrals. These aren't separate events. They're coordinated phases of a single operation. Phase 1 was accumulation. From roughly 2011 to 2024, paper market suppression kept prices low enough for institutional buyers to build massive physical positions. Every time silver approached $30 or $40, futures selling would knock it back down. Retail investors got discouraged. Mining companies struggled with low margins, but sovereign buyers and family offices quietly accumulated. They needed time, they needed low prices, and the paper markets gave them both. Phase 2 was supply disruption. China implements export restrictions. Kazakhstan limits refining output. Environmental regulations slow South American mining operations. These aren't random policy decisions, they're strategic resource denial tactics. When China locks down silver exports, they're not trying to protect domestic pricing. They're preventing Western nations from accessing Asian supply. That forces European and American buyers to compete for limited, non-Chinese production, which drives physical premiums higher, which widens the gap between paper and physical markets. Phase 3 is happening right now. Rule changes, the legal infrastructure for market failure. LBMA introduces cash settlement flexibility. COMEX expands force majeure language. Both exchanges create contractual mechanisms to avoid delivery without technically defaulting. This is the critical phase, because when the system breaks, and it will break, the exchanges need legal cover. They need to be able to point to disclosure documents and settlement procedures and say, we followed the rules. The rules allowed cash settlement. Here's your money. And phase 4 is price discovery, the phase where physical metal and paper claim separate completely. This is where the $200 target comes from. It's not based on supply-demand models or inflation adjustments. It's reverse engineered from a simple question. At what price does the pain become manageable? If silver jumps to $500 overnight, the systemic shock would be catastrophic. Banks holding short positions would face instant insolvency. Industrial users would halt production. Currency markets would convulse as investors fled dollars for hard assets. But $200? That's a number the system can absorb. It's high enough to destroy paper market credibility and transfer wealth from paper holders to physical holders, but low enough to avoid complete financial collapse. It's a controlled demolition number. The bullion dealer who said 200 is the plan wasn't guessing. He was repeating institutional guidance, the kind of guidance that flows from central banks to bullion banks to major dealers. Prepare your clients for a $200 environment. That's the managed failure point. But here's the mechanism that most investors won't see coming. When the LBMA and COMEX invoke their cash settlement clauses, they'll pay paper claim holders based on the spot price at the time of settlement. Let's say that spot price is $120. Sounds generous, right? Higher than today's price, except the physical market will be trading at $200 or $250 or $300. So paper holders get $120 per ounce in their brokerage account. And when they try to use that cash to buy physical silver, they discover it costs $250. They got paid, but they can't acquire the asset they thought they owned. Meanwhile, physical holders, people who took delivery years earlier, they're holding metal that commands a massive premium over the paper settlement price. The wealth transfer happens in that gap between paper settlement and physical reality. This exact mechanism played out in 1933 with gold. The government paid citizens $20 per ounce for their gold, then revalued it to $35. The citizens who surrendered physical metal got cash. The institutions that accumulated the metal captured the revaluation. It played out again in 1971 when Nixon closed the gold window. Foreign governments holding dollars were promised gold at $35 per ounce. When the promise was broken, they got more dollars instead, not metal. And it's playing out right now. Except this time, it's not a single government making a unilateral decision. It's coordinated across multiple jurisdictions, multiple exchanges, multiple regulatory systems. London changes its rules. New York changes its rules. Shanghai reveals it can't deliver. And when the crisis finally becomes public, when industrial users start screaming about supply shortfalls and retail investors demand their metal, the authorities will act shocked. They'll launch investigations, they'll promise reforms, they'll implement new regulations, but the trap will have already sprung. The people holding physical metal will have captured the premium. The people holding paper claims will have been settled in cash at yesterday's prices. And the people who planned it, the central banks that accumulated gold, the sovereign funds that stockpiled silver, the mining companies that secured production, the governments that designated strategic minerals, they'll have successfully transferred wealth from paper markets to physical assets. Without firing a shot, without passing emergency legislation, without causing public panic, just rule changes, cash settlements, and a very specific number that every institutional player seems to have agreed upon, $200. Not because that's what silver is worth, but because that's the price point where the paper market dies, and physical holders win. The dealer wasn't predicting the future. He was describing the architecture of a transfer mechanism that's already in motion. 3 exchange systems, 3 continents, 3 identical delivery failures. The plan isn't hidden. It's in the LBMA rulebook. It's in COMEX margin requirements. It's in Shanghai's 60-day deferrals. It's in central bank buying data, in critical mineral designations and mining company acquisitions. The only question that remains is whether investors understand the difference between owning a price and owning the metal. Because when the settlement notices arrive, that distinction will mean everything.